This is the first video of Unit 3, and as we go along, we're going to discuss about financial statement analysis and the primary functions that are covered by ratios in that. So, under this unit, we are going to have a quick recap of the ratios and major types of ratios. What are the uses of ratios in finance? How do we interpret those ratios? How do we specifically calculate the ratios? Then look at trends in those ratios and also do sectoral analysis using those ratios. This portion is going to form the cornerstone of our work that goes ahead in terms of interpretation of ratios and analysis of ratios, and hence financial statement analysis by that definition. So primarily an important topic. Some of it we might have covered in earlier sections, earlier courses. Some of it might be new at this point of time. So we start with a discussion on recap of ratios and understanding of ratios and what are the usage of ratios. So what is the concept of a ratio? Now, ratios are numbers used to analyze quantitative data around any person, business, or entity, right? So essentially, we are taking numbers, and the ratio is being calculated by dividing a numerator by a denominator to give us the concept of a ratio. And this is used to analyze quantitative data around any company, any business, any entity, any person, etc. Now, take a simple example. If a batsman scores 50 centuries in 170 cricket matches, then we can find a ratio to say that he scores a century every 3.4 matches, right? 170 matches and 50 centuries. If now we look at another batsman who has a century every 5 matches, we can compare the two and say that centuries per match 3.4 is better than 5 matches per century, right? So 3.4 matches per century is better because you're scoring more number of centuries playing lesser number of matches, right? More hundreds playing lesser number of matches. Ratios thus help us in comparative evaluation. What is the key here is comparative evaluation. In itself, a number like 3.4 does not tell us too much of information unless we go and compare this with something else. So it is absolutely important for us to understand that a ratio will only be useful for our analysis if we are able to compare the statistic against something else, right? What that something else is, we'll discuss now. We'll look at that in more detail as we go along, but primarily we will have to compare it to be able to make any sense out of a number, right? Now, in the context of finance, ratios are numbers that can be analyzed the quantitative finance aspects or quantitative data which we find in our company's financial statements. Now, it is essentially derived by dividing one data point by another. You could take two financial numbers, you could take a business number. Ratios could be calculated based on financial numbers or also based on business numbers. One example of a business number is given here, right? If a hospital has 10 beds and it generates a profit of rupees 10 lakhs per year, then profit per bed can be calculated as a ratio. This is an example of a business ratio. Why is because while the numerator is profit, the denominator is number of beds, which is one of the revenue drivers of the company. It is not a financial number. It's a business number as such, and that's why I call this as a business ratio. Nevertheless, it gives us information about the company that profit per bed is rupees 1 lakh. So if the company has 20 beds, if the company has 50 beds, you could then extrapolate and say, okay, what should be the profit of the company if the company adds another 10 beds here and if they maintain the profitability, right? So in the context of finance, ratios are essentially a very, very strong tool in giving us a quantitative analysis of what the company is up to vis-a-vis itself, vis-a-vis business and industry, right? Now, think of it. By itself, it doesn't mean too much. So when we say that a hospital generates rupees 1 lakh of profits per bed, it does not tell us whether it is above or below average. It does not tell us whether it is improving or declining as a trend, right? So effectively, it doesn't give us any information more than the fact that it's a number that we have calculated by using two numbers. To therefore calculate and analyze ratios effectively, we need certain characteristics. We need certain data points. Now, that data points is the first point that we said was we need comparison points, right? Unless we can compare the data, there is no use in this, right? So one way is to use the same ratio as comparison to other industry players. So in our example, we could calculate profit per bed for all the hospitals in the industry. So if there are hospitals A, B, C, and D, or in the context of India, if you have Apollo, if you have Fortis, if you have Wockhardt, if you have other hospitals, you try and calculate profit per bed for each of these hospitals, and then compare. Then you get a sense of whether it is better than the peers, worse than the peers, doing better than the average of the industry or not, right? You can use the same ratio also to compare historical performance of the company, right? So in our example, you could look at the profit per bed number for the last 3 years, right? Maybe this year it is 1, last year it was 0.9, and the year before that it was 0.7, right? So maybe they had 10 beds, but they were making a profit of 7 lakhs. Then at 10 beds, they started making a profit of 9 lakhs. And then at 10 beds, so this is the beds number, this is the net profit number, they made a profit of 10. So this number is moving upwards. That's an uptrend, that's an improvement, right? How do we get to know about the improvement? The company is making more profits on the same number of beds. Now, this information is only useful if we have historical data. So one way is you compare with the industry, the other way is you compare with the historical performance of the company, and the third way is you can use the same ratio to compare with the budget or target. Sometimes if you're working internally in a company, the company will say, okay, next year we should have a profit per bed of 1.2 lakhs. Now at the end of the year, you can evaluate if it was indeed 1.2 lakhs or not. This is not available for external guys. Budgets of a company are typically internal in nature, right? So these are internal in nature usually. Sometimes companies give projections to analysts in the market. So a company, a hospital might come and say that next year we're going to do this much profit. That is possibly a sort of a metric they have given to the market to understand. So maybe Apollo hospitals, just hypothetically speaking, might come out and say, next year we are going to do so and so profit per bed, right? Now you have a comparison point against what data the management has given you. So again, there are three broad points. You can compare with the industry, you can compare it with the same company history, and you can compare it with the budget slash projection slash any kind of any kind of guidance that they have given, any kind of guidance that the company has given around the company's numbers. Guidance can also be called as projection that the company has given for the next year, right? So unless you compare, it's not going to be useful. You do need a comparison point. Having said that, some absolute numbers are absolutely clear, right? For example, if your profit that you're making is negative, that's not good. You have to have a positive profit margin in a business. But is 3% good, is 5% good, is 10% good, is 20% good, is only based on what do you find out in terms of other companies in the same industry or the same company's history. Otherwise, it's a meaningless number in itself. A single number doesn't give us anything, right? The other interesting bit we need to understand is some ratios. Remember, it's a numerator by denominator kind of an analysis. So ratios could be represent either in the form of numbers, decimal values, 0.1, 0.2, for example, we did it here, or they could be represented in terms of percentages. So usually your ratios relating to profit, costs, and return on investments are expressed as percentages. We'll see examples of this as we go along. So for example, if a company makes a sales of 100 and a net profit of 20, this is represented as a 20% net profit margin, right? Other ratios are denoted as decimal values. So for example, 0.9 lakhs per bed, right? That's a decimal ratio that we have. decimal value that we have calculated. So some of them are represented in form of profits percentages. Some of them are represented in form of decimal values. Typically, anything related to returns and profits are in terms of percentages. Everything else broadly is in terms of decimal values, right? As we look at examples, it will become clearer for us to understand how does this play out, right? Let's go ahead and understand the usage of a ratio. Now, they help us in answering questions about the financial health of any business. There are certain standard ratios that are used worldwide, like profit margins, operating profit margin, net profit margin, debt equity ratio, etc. The reality is that ratio analysis is an open field, where any two numbers could be used to find a meaningful relationship to calculate a ratio, right? Now, what is important is that these numbers should have a meaningful relationship. When you're comparing a numerator with a denominator, mathematically you can pick up any two numbers and try and get data points. But that may or may not have a real relevance in the context of if one number is causing the other, or if one number is impacting the other number, right? So the idea is to figure out if there is a meaningful relationship between two numbers. Take any two numbers, like profit per bed is a meaningful relationship, right? Revenue per bed in the case of a hospital is a meaningful relationship. Revenue per subscriber is a meaningful relationship for a telecom company like Airtel, right? But some other numbers like depreciation per subscriber may or may not be that relevant, or depreciation divided by some number like a loans, right? So effectively, if a company has depreciation that they are accounting for, that's related to your asset base, right? But if you take a number of depreciation by loans, you can calculate a metric, but this number in itself is not useful. This is essentially a meaningless metric. You can calculate a number. So ideally, the two data points that you're using to calculate a ratio should have a meaningful relationship. One should be causing the other, right? You can customize any ratios based on that. Textbooks give you a certain set of 10-15 ratio definitions, but you could calculate hundreds of those to try and understand how does a business work. To understand the concept of ratio analysis better, now let us try and answer certain queries. It's good to probably frame it as a question and answer concept and understand what is it that gets answered by using a certain ratio, by looking at a certain ratio. That will give us an indication on whether or not a ratio is useful for us in the context of analyzing the company, right? For this purpose, we will look at a sample balance sheet and a sample P&L account of a company. For this point, we are not going to use the cash flow statements. We are only going to use balance sheet and P&L. So that's a sample balance sheet which has the assets of a company and liabilities of a company given. Total assets are at 1500. Total liabilities obviously will be equal at 1500. The company has total equity of this 500. Long-term debt of 500, accounts payable of 400, and short-term loans of 100. The company has long-term assets at 800, investments at 100, accounts receivable, inventory, and cash and bank balances add up to 600, giving a total value of 1500 on the asset side. The company also has a sample P&L statement which says that the sales of the company in this particular year are 1000. Then there is a manufacturing, admin, and sales and distribution cost, which gives us EBITDA or operating profit at 400. If you want, you can calculate other numbers as well. So we have EBITDA at 400. I can subtract the interest from this, which is 60 given here, and get what is called as EBIT, right? And so those numbers then come in, and then eventually we arrive at a net profit number here, earnings before depreciation, tax, etc. You first remove the depreciation here by 60 to get to EBIT, which is 340, and then you remove the interest, which is 60, to get to profit before taxes, which is 280, and then you apply taxes to it, which is 120. So minus, 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 and you keep getting at these numbers as you go along to arrive at yardsticks of the company's performance, right? So that's calculated on the company's P&L statement. Now let's look at what are the various kinds of ratios that are available. right? So we can look at something called as profitability ratios, which talk about how profitable a business is. We can look at return ratios, which talk about what is the return on capital or your investment. You put some money in the business, how much money does it give you back essentially, right? Then you look at coverage ratios, which is about what kind of cover the company has for liabilities. If a company has liabilities, how much cover does it have there? Stability ratios typically talk about long-term liabilities or interest-bearing liabilities, which will give us an idea about debt equity ratios. Liquidity ratios talk about how much liquidity a company has to deal with short-term issues. Let's say there is a sudden concern on cash requirement by a company. Liquidity ratios throw an important idea about that. Efficiency ratios talk about how efficient the business operations are, how much sales the company is generating by using a certain amount of assets essentially. And other ratios could be on growth and other metrics. Right now, again, remember that while we will look at our sample balance sheet and P&L to calculate it, note that a single number, an absolute number that we calculate, or a single number that we calculate does not give us too much information, right? It does not give us too much information other than a few specific ratios where it might start giving us more information. Only when we compare numbers, a relative understanding of these numbers is where it is going to become important. That's something we're not going to look at this point of time. And some of these data points are immediately going to be only for a recap. We will look at specifics of each of these ratios in detail as and when we take examples about various companies and understand those numbers there, right? So the implication of those will become better when we look at examples, real life examples of companies, and look at all the ratios again for those set of companies, right? Let's begin with the profitability ratios. Now, what are the types of questions you could answer based on that? How do you analyze if the business is more profitable for a business conglomerate? Let's say Reliance is a company which is in chemicals, which is in telecom, which is in petrochemicals, which is in retail. Which business is more profitable? Two, how do you analyze if profitability is improving? How do you analyze if a company is more profitable as compared to another company? How do you analyze if a company generates more profit per rupee of sales generated? Right? That's where profitability ratios come in. The key ones are operating profit margin, also known as OPM, calculated as EBITDA by sales. In certain cases, certain textbooks also talk about operating profit as margin as EBIT by sales. You can use either one, but just remember that you use it across the metric, across the calculation, across the range of calculations that you're doing, relative comparison that you're doing. You use the same number. Ensure that you use the same definition, right? Uh, the second one is net profit margin, which is the final profit divided by sales. If we look at our example, this particular company is generating 40% profit, operating profit margin, which is essentially that for every rupee of sale, for every rupee of sales, the company generates 40 paise of operating profit. Right now, we remember that operating profit is more for operational work around the business, and then final profit is more for the business shareholders. Right? This company seems to be producing 16 paise of final profit. Now, as I said, doesn't give too much of information other than that if we, unless we compare it to some of the other peers in the same industry, or we look at history and see, okay, last year what was the number, right? So that's practically the calculation that happens on profitability ratios. More detail when we look at individual companies and examples on that. Let's look at return ratios. So what question does this try to answer? If you are an investor and you are trying to buy a business, how much return will you make on your investment every year is what the total return ratios talk about, right? Now, return ratios could be of multiple kinds. Just remember that whoever is making the investment, you have to look at the return for all of them, right? Why do I say this? So there are two kinds of return ratios, something called as return on net worth, which is also known as return on equity, right? So here you look at what is the return for the equity holder. So what's the denominator? Share capital plus reserves, which is what is the equity component in the business. In the numerator, you're looking at net profit, which is the payoff to the equity guys. right? Now, when you look at extending this analysis, the company gets money not only from equity guys, but also from the debt guys. So if you were to extend the analysis to look at returns of equity plus debt guys, then in the numerator, you cannot use net profit. Why? Is because net profit does not give what is the return that the debt guys made, right? So you have to use a measure of profit that includes what debt guys made, right? Which is why you typically use EBIT here. EBIT, if you look at the term, EBIT will include interest, which is the component that the debt holder will make. Tax is what the government makes, and that's a constant, so you can remove it. What is left is net profit, which is the equity guy that makes, right? So EBIT includes the component of payment that is made, or return that is made, by both the equity guy and the debt guy. And hence, in any metric around returns where you're using funds taken by both equity and debt guys, then you have to use EBIT in the numerator. That's just a better way of calculating the ratio, right? Now, there are three kinds of ratios we looked at here. There could be more. So we're looking at return on capital employed, return on long-term assets, and return on net worth. Remember, long-term assets can essentially be funded by both shareholder funds and loans, and hence I'm looking at EBIT here as well. There's no hard and fast rule around it. You could use net profit by long-term assets as well. Typically, if you're using total assets, remember, total assets are equal to equity plus debt. So in this case, you should be using EBIT. In any case, most of the times, this is going to give a similar analysis as return on capital employed, right? Let's calculate the numbers. Remember, what was EBIT? EBIT was 340 that we had calculated here. So that's our EBIT, 340. And we had the other numbers available here. Long-term value of assets is 800, total assets is this much, debt plus equity is given as 500 plus 500. So your numbers would be essentially return on capital employed is 34%, return on long-term assets is 340 by 800, that's 42.5%, and return on net worth is the net profit, which is 160 divided by shareholder equity, which is 500, so 32%. They look healthy numbers, but once again, we don't really get a handle on whether they are good, bad, improving, diminishing. What is the data around that? That we will only get once we have comparison points. Return ratios typically talk about how much return someone makes when they give money to a business. Then we go to coverage ratios. Now, what are coverage ratios? Essentially, let's say you work for a bank. A company comes and asks me for a loan. What do I analyze to understand whether this company can repay the bank's loan, right? That's where the term comes in around coverage, which is saying that how much money do you have to cover for loan related expenses, right? So what are loan related expenses? Typically your interest is the most common loan related expenses. Where is the interest coming out of? So if you look at our calculation, we had calculated EBIT, and from EBIT you have to pay the interest. So if you just look at the P&L, you have EBIT, and from this you subtract the interest, right? So how much cover does your profit have over your interest? That gets calculated by a ratio called EBIT by interest, right? In our example, we see interest coverage ratio is called as 5.66. That's EBIT by interest. Then sometimes what you could also see is how much money does the company actually have, cash that the company has for repayment of interest and debt, right? Now, if you look at the EBITDA of the company, out of the EBITDA, only tax goes outside. Depreciation is a non-cash expense. So what is left is EBITDA minus current tax. That is the amount that the company has for itself. Now from this, you have to pay both the debt repayment and the interest. That's the cash that the company has for itself. And then you have to look at debt repayment and interest. So you could calculate this as well for a company. There are multiple kind of ratios. Some of them will be useful in certain cases. Some of them may not be useful. Finally, you have something called as net debt to EBITDA. If a company has cash and cash equivalents of, let's say, 100 crore and debt of 400 or 500 crore, then you don't necessarily need to pay the entire thing because you already have cash. So technically, the cash could be used to pay off some part of the debt. Net debt is the debt after you have accounted for cash numbers, right? So let's look at our numbers in the balance sheet. The debt number is, I'm assuming long-term loans only for the time being, that's 500. Your cash is at 100 and investments are at 100. So cash and cash equivalents add up to become 200. 500 is the loan amount, which means technically you don't have cover only for 300 of those. 200 is already available in the form of cash, which you can repay immediately, right? So 200 is taken care of. The remaining 300 is what comes here. And how much EBITDA or cash are you generating every year? So your net debt to EBITDA ratio also kind of gives you a sense of comfort about the company. Note that these numbers are now decimal numbers. They are no longer percentage numbers. Your return ratios and your profitability ratios were all percentage numbers. These numbers have now become decimal numbers, right? Again, the individual implication of each one of these becomes more important when we look at trends. So we'll come to that in the context of our understanding. Then we have stability kind of ratios, which is basically the debt equity ratio. There are two kinds of ratios here, and you have long-term debt by equity and you have total debt by equity, which includes long-term plus short-term debt. So you calculate the ratios for a company. Again, in itself, this number is not very important. What is important is when you look at debt equity ratio in conjunction with interest coverage ratio. Both of these put together give you a very important yardstick about how the company might be performing. So that's your debt equity ratio. If we calculate long-term debt by total equity, which is shareholder equity, you get 1 here, 500 by 500. And if you add the short-term debt, which is 100 crore, that becomes 500 plus 100, 600, and you calculate the ratio as 1.2. Next, we move to liquidity ratios. Now, if you have a sudden cash crunch in the financial markets tomorrow and companies have a serious trouble in raising cash for running businesses, how do you know which company will be able to meet short-term obligations? Short-term obligations are current liabilities. So you have to meet your current liabilities. Effectively, you can only meet your current liabilities by your current assets. So current assets provide a sort of cover for your current liabilities, and that is what you are trying to calculate here. The first ratio is called current ratio, which is called current assets plus divided by current liabilities. A more stricter form of this ratio is called as quick ratio, where from your current assets you remove the inventory. Inventory may not be liquidated as quickly, but cash and receivables are considered more liquid. So essentially, cash plus receivables divided by current liabilities gives your current your quick ratio, right? Calculating this for our sample company, 1.2 is the current ratio and quick ratio is 0.8 because there's about 200 of inventory, which may or may not get liquidated immediately, right? There are textbooks which talk about certain specifics of current ratio, saying a certain ratio is good. But in reality, we'll see that companies manage at all sorts of current ratios. And what is more important is how much money they generate on a day-to-day basis. If the company generates a lot of cash, that is important as a metric, right? That's the liquidity ratio. Next, we move to efficiency ratios, also commonly known as turnover ratios, right? Why are they called as turnover? Turnover is another name for sales. Effectively, in all of these ratios, sales will be the numerator, right? So essentially, how much sales do you generate by using specific metrics around assets? What kind of assets are you using, right? So which company is managing working capital better? Which firm uses its assets better? So inventory turnover ratio is how much sales you generate on inventory. Receivables turnover ratio is how much sales you generate on account receivable. Asset turnover ratio is sales generated on total assets. Now, some of these definitions in textbooks are cost of goods sold by inventory, for example, inventory turnover ratio. We will look at the implication of using sales in this. Why is using sales more important or better, especially when you are comparing companies? Especially when you are comparing companies, it is better to use sales in all turnover ratios, right? If you look at sales by total assets, it's a way of saying if a company uses less assets to generate the same amount of sales, it is more efficient. right? So this company generates 1000 crore of sales at 1500 crore of assets. If there's another company that generates 1000 crore on 1200 crore of assets, this company is more efficient because they're generating more sales on the same amount of assets, right? Similarly, how many times do you turn your inventory over in terms of sales? How many times do you turn your receivables over in terms of sales? Usually the numbers are higher the better. Higher the better in this case, right? Efficiency ratios, the higher amount of sales you can generate for a company out of a certain amount of assets that are used, the better it is, right? So the numbers are higher the better for efficiency ratios. Finally, other kind of ratios that come in, which is growth ratios. How do you measure the growth of a company? Now, to measure the growth, you do need data points around more than 1 year. You cannot calculate growth otherwise, right? So if you look at data points here, we have taken revenues and P&L accounts for the last 2 years of the company. Sales growing from 800 to 1000 and profits growing from 100 to 160. Also, we assume that sales volume, right? Volume is the number of units of whatever this company is selling. Let's say the company sells cars. They were selling 400 cars last year. They're selling 500 cars this year, right? So how do you calculate growth? Growth could be in terms of volume growth, is quantity growth essentially, right? And then it could be in terms of value growth, which is rupees growth essentially. What is the value? So you can compare the two and say whether the cars are growing at a faster rate than the volume is growing at a faster rate than the price of the car as well, right? And that value could come out. EBITDA growth and net profit growth. Each of the numbers is the current number minus the previous number, whatever period you're looking at the growth at, and divided by the previous number. In other words, change that you have divided by the initial starting number that you started with, right? Let's calculate that. Sales volume growth, 500 units minus 400 units divided by 400 units is 25%. Sales value growth is also 25%, which logically means that price has not grown, right? EBITDA growth is 400 minus 300 by 300, that's 33%, and net profit growth is 160 minus 100, that's 60%, right? So profitability growth has been faster. So that's about growth ratios that we were looking at, and largely what is the idea of these growth numbers that you calculate year on year for a company, right? That's the second kind of ratios that come up. Within growth, we could look at growth over multiple years as well. That's a ratio which we'll cover in one of our next topics. That's called as compound annual growth rate, CAGR, which is essentially going to give growth over a period of time. We're going to assess this and learn this in one of our subsequent sections. So that's it in terms of a quick recap of ratios. Now we're going to extend this in terms of calculating all these ratios for specific companies, and then extend this entire analysis in terms of understanding what some of these ratios mean and what is the implication with respect to industry analysis.